Ladies and gentlemen, hello and welcome to yet another episode of The Age of Alternates, the podcast series presented by Vivriti Asset Management, where we demystify the world of alternates. In today's episode, we will talk about how AIF schemes hold more relevance in client asset allocation, different private credit strategies in the market, and the key factors in selecting private credit funds. To understand the topic in best possible way, we have with us Pawan Kumar Choudhary, Head of Investment Research and Advisory Function at Client Associates, one of the leading multifamily offices in India. Pawan brings more than 13 years of experience in equity and debt markets with experience across asset management, stock selection, credit rating, asset allocation, and investment advisory. His team carries an impeccable track record of view of Indian equity and debt markets. He has been a regular speaker on equity and derivatives at leading business schools in India. Pawan, thank you for taking time out and welcome to the show. On the other side, we have with us Mohamed Irfan, our fund manager, who comes with an experience of over a decade across finance, strategy, and credit investing in multiple sectors. Previously associated with Aditya Birla Mutual Fund, as a fixed income portfolio manager, Irfan has successfully managed several high-yield exposures and is experienced in negotiating, structuring, and post-investment management of credit. Gentlemen, over to you, and we look forward to an informative and interesting conversation.
Thank you very much for the introduction, Resham, and welcome, Pawan. Hope you're doing well. Thanks for coming and taking time out for the show.
Thank you, Irfan.
Great. So, I know that you've been very, very instrumental in how AIFs kind of have been growing in India, been advising through your firm to a lot of market clients that you have. But, since it's been more than a decade since AIFs have come into action, they've grown pretty well over the last few years, last 5 years, clocking a CAGR of more than 40%. Of course, started with a low base and so on and so forth. But today it seems to be finding a lot of interest amongst investors, wealth, high net worth individuals, and so on and so forth. So wanted to kind of pick your brain since you are in the thick of it. How are you seeing this space sort of shape up in India?
Sure. I mean, we all know, alternative investment is an integral part of an efficient portfolio. I mean, we can't imagine constructing an efficient portfolio without giving allocation to, let's say, private equity, venture debt, performing credit, long short funds, And you are so right, I remember in 2017, we had about 300 AIFs in India. And today we have about 1,040 AIF across all the three categories, Cat 1, Cat 2 and Cat 3. In 2017, we used to manage, I'm saying Cat 1, Cat 2, Cat 3 together. The AUM was about 30,000 crore. And today it is more than 3 lakh crore. So we have seen, a remarkable growth in both number of funds and the AUM. And so yes, the first part is that we have grown. But if I see global markets, let's look at the US markets. The market cap of listed space in US is about $26 trillion today. And if I look at US hedge fund industry, and the size of US hedge fund industry today is about $2.7 trillion, which means US hedge fund industry accounts for about 10% of the listed space. Now let's look at numbers in India. If I look at the AIF AUM today in India, which is about 3 lakh crore, as compared to the market cap of the listed space, which is about 300 lakh crore. Which means that currently our AIFs account for about 1% of the total market cap of the listed space. And within, alternative investment, as we say, within AIF, if I look at private credit and long short, they account for less than 0.5% of the total listed market space, which tells us that there's a lot of headroom available to us, and I expect this strong momentum to continue in this space, and in the next 3 to 5 years, we will see, a very good growth, not only in terms of AUM, but also in terms of newer strategies. Because each, alternative investment is an umbrella term, it's a macro term, but within this term, we have private equity funds, we have performing credit, we have structured credit, we have long short funds, and newer strategies are coming. And each strategy, each sub asset class, it's solving a specific problem, which is not possible in the traditional asset class space. So I strongly believe that the strong momentum that we have witnessed so far in this space, it is likely to continue in times to come also.
Yeah, I understand. And, I mean, from the asset side, I can just share with you that, it's the number of opportunities that we see in terms of being able to deploy in companies, through our structured credit products and so on and so forth. That has also increased very manifold over the years. But, since you are managing wealth for so many marquee, family offices and ultra HNIs, how do you kind of go about deciding on their allocation to alternate investments, right? Because I'm sure there's a framework behind this, a thought process as client associates behind this. If you can just give us an insight on that, and how has that experience evolved over the last few years also? That'll be very helpful to our viewers.
Sure. So you have asked two questions. The first one is, how do we decide our allocation to alternative investment? And the second one is, how have been our experience of advising, let's say, AIFs, alternative investments to other investors? First, I'll try to answer first question first. Irfan, we follow a model portfolio approach. And in fact, we construct 7 model portfolios basis different risk profiles. And naturally, as we move from conservative to moderate to aggressive, our allocation to alternative investment, it comes down. However, I want to highlight a very pertinent point here, very important point here. Just because I'm investing in one of the AIs, it doesn't mean that I'm taking higher risk over a traditional instrument. For example, if I'm investing in CAT 3 absolute return fund, my risk is considerably lower than a small cap mutual fund, which could be small cap long only equity mutual funds, right? But broadly speaking, yes, as we move from conservative to moderate to aggressive, we decrease our allocation to alternative investment. And what factors influence our decision? Broadly, we look at 3 things. One is, obviously, we have examined global portfolios. We've looked at efficient portfolios managed by pension funds, endowment funds globally. And we've seen that they give 20-25% allocation to this space, alternative space, for a moderate risk profile portfolio. That's number one. Number two, there are a few constraints, which is availability of a good quality manager. Let's say I want to give 25%, 30% allocation to alternative investment, but I may not find a manager in a particular sub-asset class who is currently at that time raising money. So that's the second factor. And third, which is the most important factor, is that for me, each alternative investment should solve a specific problem. And just to give you an example, let's say if I am investing in a private equity fund, the first question that I ask myself that, if I am invested currently in listed equity, what am I getting in terms of my expected return? We all know, it's very clear that I'm going to get risk-free return plus equity risk premium. Let's assume risk-free return is 6.5-7% and equity risk premium is 4.5%. So my expectation from listed equities, let's say 11-12%. Now, can I get, and when I'm investing in, let's say, private equity or unlisted equity, I'm taking 2 more risks: liquidity risk and size risk, right? And as we know, there are many models, there are many, research, publications we have studied that as you increase your risk, over and above, let's say, the capital equity market premium risk that you are taking, which is coming in the form of illiquidity risk and size risk, you need to ask for more return. So for me, the benchmark is obviously 15%. So I'll see whether a fund is solving a particular problem or not. So combining these three, like examining global efficient portfolios, understanding the risk profile of the client, looking at the risk and return profile of the particular manager, and availability of good manager. All these decisions, they help us decide allocation to alternative investment.
Very true. And I kind of see this two sides of the same coin, because right now when we are looking at deploying assets in the funds that we manage here, we always see that volatility is here to stay. Current market dynamics are fairly difficult to price in right now. A lot of unprecedented stuff. Right, so when we analyze companies, we the way we analyze, sometimes models are not there to analyze these cases and scenarios, right, where we currently are. But on allocating wealth, the problem becomes as acute, if not more, I would like to think. So how important do you think is the? Of course, it's important the way clients allocate, but what do you think in this current market scenario? How important do you think clients should? Is it for clients to kind of stick to a certain allocation strategy? Some people say you should. Some people say you should go all in or all cash. There are various schools of thoughts, right? So just wanted to know your thought process of that. I know you've mentioned that there's a conservative, moderate, aggressive kind of a model portfolio, but current market volatility is so dynamic. Your views on that right now.
Sure. So Irfan, we have developed multi-factor models to form a view on equity and debt markets. So if I talk about traditional asset classes, these are two asset classes broadly we cover. And as far as alternative investment is concerned, we used to use this space as a tactical opportunity, which now has translated into a strategic investment. So when I am giving money to a private credit fund or a long short fund today, it has become my strategic investment than the tactical allocation that it was earlier. Now coming to the views on the market, I'll start with equity. Currently we are neutral on equity market. Base is the model that we follow. So the model looks at economic cycle, it looks at earning cycle, and then it combines earnings, economic cycle with the valuation cycle.
Does that mean that if your model would ask for someone to have a 20% allocation or 40%, for example, when you're saying you're neutral, you're saying you are at 40%, not going to 45 or going to 30? That's
exactly. So if I'm neutral on equity, I'm advising the policy allocation. And if I'm overweight on, let's say, equity, I'm advising policy plus. Let's say if we go overweight plus, overweight 1, we advise 10% more than the policy. If we go overweight plus, we advise 20% more than the policy. So currently, basis our model, we are neutral on market. And there are many reasons why, because India remains the only country where expected growth is more than 6%. It is slightly higher than long-term average. You will not find a single large country in the world today which is likely to report a growth that is slightly higher or in line with long-term average. Now, growth is just one factor. You have inflation and interest rate also, which are equally important. Again, India is the only country, large country, I would say, that has managed inflation very well in the last 1.5 years, and projected inflation in the next 1 year at about 5% is slightly below the long-term average. I'm talking about India, and you look at any developed country today where projected inflation is going to be considerably higher than long-term average. Right? Look at earnings growth. Last year we clocked an earning growth of about 18%. This year, market is expected to report an earning growth of about 17%. Right? And valuations are fairly priced. I won't say they are attractive. Maybe we are paying 3-4% premium basis different indicators, but combining all the factors, we are neutral on equity we are negative on debt mutual funds, while we are neutral on yield, but we are negative on debt mutual funds. We are not giving fresh allocation to mutual funds, and we are overweight or positive on private credit and absolute return strategies. And the strategic shift here is that earlier, let's say till 2020-21, we were opportunistically using alternative investment as an asset class to give allocation, so any allocation that was coming to us and we were underweight on, let's say equity or debt, we were utilizing, money to deploy in alternative investment. But now it has become a strategic investment for us.
No, this is like very, very instructive actually, because it kind of, when you're talking about debt, typically the questions that usual manager is faced with is what are the strategies that you are deploying, how are you managing it, and so on and so forth, right? Like as a typical fund manager, I'm saying, when you are looking we are deploying a particular strategy, and that's part of the bouquet of options that you currently have, right? When you're looking at debt per se, you mentioned debt mutual funds, you mentioned private credit strategies, but within private credit strategies also there are multiple different strategies. In your view, how do you categorize these strategies?
Sure.
Allocation view, wanted to understand that. And also, what is your view within the private debt strategies bit? Also curious to know why you are underweight debt mutual funds, to be honest.
It's very clear, because I'll first answer your question on the debt mutual fund, because we all know that the new debt MF taxation rule requires investors to pay marginal tax rate on the gains from debt mutual fund income. So let's say if the net YTM of a short-term fund is about 7%, 6.5%, and if an individual investor is placed in the highest tax bracket, he'll pay 39% tax on it. So post-tax return is not going to be more than 4.5%. So in fact, Irfan, it is extremely difficult to outperform inflation on a post-tax basis by investing in debt mutual funds currently, by investing in market-linked debentures, by investing in, let's say, NCDs, AAA rated NCDs, etc. So it's because one of the objectives of constructing an efficient portfolio for us is to preserve capital and outperform inflation on a consistent basis, on a post-tax basis for investors who are conservative. But because of this change, there's a reason we are negative on debt mutual funds, while we are neutral on yields.
Understood. Basically post-tax yield given the taxation benefit has gone out. Understood.
Yes.
Got it.
What was your first question?
It was on within the other strategies that you're looking at. How do you look at it, right? Because you will be having a bouquet of various different strategies in the market that way.
Sure. If we look at private credit space, we start with performing credit. Then we have structured credit. Then we have distressed credit. And then let's say we have venture debt space. Broadly, there are these 4 sub asset classes within private credit, which are available in India currently. Till 2015-16, if I was giving money to a manager in the private credit space, it was only structured credit or maybe. But fortunately, now we have managers who are running these different mandates. Now, how we are considering our allocation to each bucket? First, I'll share the conclusion that we are constructive on the first 2 subcategories, which are performing credit and structured credit. The reasons are very simple. When I'm investing in a performing credit, the incremental risk that I'm taking over a debt mutual fund is not huge. Wherein my underlying manager, he is focusing on PD and LGD. But the key here is PD. He is not giving money to, companies which are loss-making. He is giving, money to, let's say, companies which are already rated, which are already banked. It's getting good collateral. Average rating may be, A-, but the leverage and coverage ratio of his portfolio may be even better as compared to a AAA or AA rated, companies or portfolio. So therefore, I'm very comfortable with performing credit. Let's say I won't hesitate taking Vibhuti's name here, because I know Vibhuti is known for performing credit, and I think you guys have done really well in this space. And I definitely consider allocation to Vibhuti's performing credit funds for the reasons I mentioned, that I'm comfortable. Because my idea here is, I can't invest everything in the risky assets. My idea is very simple, that I have to outperform inflation on a post-tax basis without taking very high, risk. I don't want a situation where the manager goes to the LGD scenario, right? Then coming to the structured credit, I'm still comfortable giving allocation to, a few managers in the structured credit space, because the way they structure the deal, they take hard collaterals, they get access to cash flows, etc. So these are the two spaces we are actively considering out of the 4 segments that I just highlighted.
Understood. And in terms of, so once you choose a category, of course, like, thanks for mentioning that you're constructive on Vibhuti AMC also. But overall, when different people look for, or different allocators look for different things in an AMC or a fund manager, so some strategy, some of them I've heard various things, but wanted to understand, when you're assessing an AMC or a fund manager to back with your allocation, what are the things that you look for in a key sense, right? So that our viewers also kind of get a little bit of nuggets as to how they can also go about selecting in their individual portfolios. But how do you go about looking at this fund manager selection, not your macro and your asset class view? Once you zeroed in an asset class, how do you go beyond that, right? Like, just some thoughts there.
Sure. So one, at Client Associates, we follow a 4P approach. We start with the platform. It's very important, the way you do corporate governance analysis of the underlying company, we also try to understand the corporate governance issue with the platform, credibility in the market, the size, etc. So platform, first P is platform. That is very important for us. Second P is people. We all know it's all about people behind the platform. Who is managing the fund, his experience, her experience of managing credit across cycles. Let's say I'm specifically highlighting credit here. And third P is obviously performance, track record, whether the manager has seen 2 or more business cycles or not. Because discussing risk is just one thing, but managing risk when the situation arises is a very different skill set. Reading risk in book is very different than managing risk at hand. So this is
agree more on that. No,
equally important for a credit manager. So track record, it's not about only the historical performance. It's about managing risk across cycles, because we call ourselves risk managers. We call ourselves custodian of the wealth. So that's the third P. And the fourth P is obviously process. See, we are more interested in the process than the underlying companies, because once we are clear about the process, and once we think that the manager is clear about the process, the underlying company is the outcome of the process only. He has the discretion and all the flexibility to change underlying companies. But once we are clear and he is clear on the process, I think, so we score each manager on these 4 parameters: platform, people, performance, and process. And this is how we decide a manager within each sub-asset class.
Understood. And if I just ask a broad overall number of within, like, so all of your allocation, right? There's equity, there's debt, and the other asset classes that you're operating in. Just within the private market, that is private equity, PMS, and equity and credit, all of this, how many asset managers do you actively allocate with all asset classes put together right now?
Okay.
So if someone is coming to you, or and allocating wealth with you, you're letting you manage wealth, what is the broad bouquet that he knows that you're picking and choosing from? Just a number.
Sure. So let me answer this question slightly in a slightly different way. Let's look at debt, right? And how I'm constructing my debt portfolio today. So the way to look at debt, for us is that we are following the core and satellite approach. The core is, let's say, a client is already invested in debt mutual funds, and he had invested before 31st March 2023. So I'm not going to touch that portion. Now on top of it, I am running two satellites. The first satellite is a portfolio of private credit funds. The second satellite is a portfolio of absolute return strategies. You may call them long short hedge fund or absolute return hedge fund. Now within private credit, as I mentioned that I like performing credit and structured credit, and got one manager. In fact, two managers I got in the performing credit and one manager I got in the structured credit. In the second satellite, which is the portfolio of absolute return strategies, I have selected three managers. So now you look at my debt portfolio. Let's assume 50% allocation you have given to debt mutual funds.
MF, yeah.
Right?
Yeah.
Now 50% allocation you are dividing between two satellites, portfolio of absolute return strategies, portfolio of private credit strategies. Within that, you are allocating to three managers in each of the bucket.
Understood. So fairly diversified within strategies also, and as a strategy also, it's sort of diversified. Got it. Fairly clear. So that brings the end to our segment. Thank you so much, Pawan, for sharing your insights on this. Happy to have had you on Age of Alternates, and have a great day.
Thank you.
Over to you,
Thank
Resham.
you.
Thank you so much.
Thank you.
Thanks, Pawan and Irfan, for carrying out such a captivating session. It was extremely fascinating for us to learn about the different models of asset allocation, the 4P approach for selecting private credit fund managers, and so on. Hope everyone enjoyed the session thoroughly. We look forward to hosting more of these in the near future. Thank you for being with us, and thank you for giving us your time. We'll see you next time.